All right, section 70110, termination of miscellaneous itemized deductions other than educator expenses. Again, changing the date of all these things, and the deduction allowed by section 162 for educator expenses as defined in subsection G, inclusion of coaches and certain non-athletic instructional equipment. Okay. Educator expenses, if you're a teacher, you're familiar with this, I'm sure, where you can get a Schedule 1 deduction of a few $100 worth of educational expenses, and apparently they're including athletic instructional equipment. And yeah, that's going to go into effect once in 2026, once the Tax Cut and Jobs Act stuff expires. What used to happen? Termination of miscellaneous itemized deductions. So on Schedule A, there used to be a section at the bottom of miscellaneous, and that included a couple things. The most notable of which is probably unreimbursed employee expenses. So I've had people come to me and say, hey, I have a home office, so that's deductible, right? I said, let me ask you, is it home office for a job that you work at and you get a W-2, or is it home office for a business that you have of your own? And if they say, oh, it's for my W-2 job, so then you're out of luck. It doesn't do anything because this section right here. So that those type of things where you work as an employee and you have your own expenses used to be deductible subject to a 2% AGI floor, blah, blah, blah. But part of the Tax Cuts and Jobs Act and now made permanent, those things are gone. If you are spending personal money for your employer or on behalf of your employer, get reimbursed or just realize that's money out of your pocket, reducing your net earnings. One of the two. So, all right, section 77111, limitation on tax benefit of itemized deductions. And in the case of an individual, the amount of itemized deductions otherwise allowable for taxable year shall be reduced by 2/37 of the lesser of such amount of itemized deductions or so much of the taxable income of the taxpayer for the taxable year determined without regard to this section and increased by such amount of itemized deductions as exceeds the dollar amount at which the 37% tax bracket would under section 1 begins with respect to the taxpayer. That's a whole lot of stuff. Coordination with other limitations. Limitation not applicable to determination of deduction for qualified business income, which is section 199A type stuff. Patrons of specified agricultural and horticultural cooperatives. Very rarely see that. And obviously this kicks in at the end of 25 into 2026. So basically, if you are a high income earner and you have huge itemized deductions, then you're going to be limited on how much of those itemized you can actually use because they want to keep you in the 37% bracket, basically. So this affects very few people, but if you're a very higher income earner, then that's going to continue. Okay, so let's see. Section 70112, extension and modification of qualified transportation fringe benefits. Okay, a lot of striking subparagraph D of section 1 and paragraph 2 and inserting and inflation adjustments, which is always helpful, coordination of disallowance with certain expenses, and basically they're saying you can't deduct qualified transportation fringe benefits. That's not too common, could affect some people. Section 70113, extension, modification, a limitation on deduction and exclusion for moving expenses. So in the old days, again, this was the change back in 2017. If you moved at least 50 miles for work purposes, then your moving expenses were deductible. And they got rid of that at Tax Cut and Jobs Act. And then this is continuing that and making it permanent. Now, there are several states that still allow for moving deductions. Also, there are some states that allow for 2106 expenses, which is that unreimbursed employee stuff. California, notably, is one of them that does allow for those deductions. Interestingly, California does not allow for HSA contribution deductions. It's just how they like to do things over there. This is going to continue and being made permanent, basically. Okay, so there's exceptions if you're in the intelligence community or if you're in the reserves or what have you. And let's see. Section 70114, extension and modification of limitation on wagering losses. Okay, this one's kind of wild. In the old days, you would pay taxes on your net gambling winnings. So let's say you won $10,000 and you lost $15,000. You have a net $5,000 loss. You're not going to pay any taxes. Now, what it does do is it screws up your AGI because you show the winnings on the income side of things, and then the losses go into your itemized deductions. So especially with the larger standard deduction that we have now, it's harder to itemize. And so if people had gambling losses but were not able to itemize, that still hit them for a tax that they otherwise would have been able to deduct. But assuming that you are able to itemize, then gambling winnings, gambling losses net out to zero. You can't go below zero, and everything was fine. However, this is changing. So, for purposes of losses from wagering transactions, the amount allowed as a deduction for any taxable year, A, shall be equal to 90% of the amount of such losses during such taxable year, and B, shall be allowed only to the extent of the gains for such transactions during such taxable year. Special rule, for purposes of paragraph 1, the term losses from wagering transactions includes any deduction otherwise allowable under this chapter incurred in carrying on any wagering transaction, and this goes into effect 2026. Okay, so what does this mean? This means that, let's say you win $10,000 and you lose 15, you're going to be able to deduct 9. So you're going to pay tax no matter what on $1,000, on that 10% difference here between 90 and 100%. Now, if you do a lot of gambling, whether you win overall or not, most people don't, then this is going to hurt a lot. Because I've seen people with hundreds of thousands of dollars worth of gambling winnings. I've seen those same people with more than that in losses. But if you've got $300,000 worth of gambling winnings, then you're going to be paying taxes on 30,000 of that, no matter what, which is wild. So just know that going into it, that even if you lose overall, you're still going to be paying taxes on it, which is generally not what most people think of when they come to what's fair, but this is the new law of the land starting in 2026. All right, section 70115, extension and enhancement of increased limitation on contributions to ABLE accounts. So ABLE accounts are great. They're like Roth IRAs for disabled people. And let's see, effective date is 2026. And modified inflation adjustment, the adjustment made by subsection A1 shall apply to taxable years beginning after 2026 and going forward. This is great. And the Tax Cut and Jobs Act increased the amount that you could contribute, and that is going to continue. And the amounts that you can contribute are going to increase related to the cost of living adjustments. So great. Section 70116, extension and enhancement of Savers credit allowed for ABLE contributions. So the Savers credit is a tax credit that is given for retirement contributions, basically, but also for ABLE contributions. And in general, the term qualified retirement savings contributions means with respect to any taxable year, the sum of the amount of contributions made by the eligible individual during such taxable year to the ABLE account, of which such individual is the designated beneficiary, and in the case of any taxable year beginning before January 1st, 2027, which is going to be 2025, 2026, the amount of qualified retirement contributions as defined in section 219E made by the eligible individual in the amount of any elective deferrals of such individual and any elective deferral compensation by such individual under an eligible deferred compensation plan of an eligible employer described in section 457. So coordination with Secure 2.0 Act of 2022. Paragraph 1 of Section 103E of the Secure 2.0 Act of 2022 is repealed, and the Internal Revenue Code of 1986 shall be applied and administered as though such paragraph were never enacted. Okay, so Secure 2.0 Act was a big act that was passed in 2022, and let's see if we can get the code section there. Let me pause this for a second. All right, paragraph 1 of Section 103E of the Secure 2.0 Act of 2022 is repealed. This kind of sucks because this is Section 103, the Savers match. So in general, subchapter B of Chapter 65 is amended by adding at the end of the following new section, in general, allowance of match. So basically what this said was that if you were a low-income earner and you contributed to retirement accounts, the government was going to kick in up to an extra $1,000 to your retirement account. That's what Section 103 was about, the Savers match. However, that is now gone. And it was set to kick in 2027, and now it's not going to happen. Let's see, which is unfortunate. Yeah, there is still a non-refundable credit, that is the Savers credit, but the change that was going to happen is now gone, which makes me sad because I had calculated that if you did that for kids who were on payroll, then that could grow to up to about $600,000 at retirement age. But now it's gone. All right, Section 70117, extension of rollover some qualified tuition programs to ABLE accounts permitted. So if you had a 529 plan, and ABLE accounts do come under the 529 framework, then you can roll over from an education plan into an ABLE account if somebody is disabled and qualified for ABLE accounts. Section 70118, Extension of the treatment of certain individuals performing services in the Sinai Peninsula and enhancement to include additional areas. You'll see this in lots of tax bills, and you'll be thinking, what is this about? There are certain people in the Sinai Peninsula and other places, including Kenya, Mali, Burkina Faso, and Chad, included as hazardous duty areas. So this is not going to apply to many people outside of the military, but yeah, so they're adding some areas there. Section 70119, extension and modification of extension and modification of exclusion from gross income of student loans discharged on account of death or disability. Basically, in the case of an individual, gross income does not include any amount which, but for the subsection, would be includable in gross income for such taxable year by reason of discharge in whole or in part of any loan described in subparagraph B if such discharge was pursuant to subsection A or D of section 437 of the Higher Education Act 1965 or the parallel benefit under Part D of Title IV of such act pursuant to yada yada loans discharged. And basically, if, like it says up here, if your student loans are discharged on because of death or disability, then you don't have to include that as part of your taxable income. So that's helpful. All right, and there are some caveats with that. That's the general thrust.